Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds.
A catch-all video. It's Stock Cheat Sheets, it's Macro Monkeys, and it's Chaikin Power Users, which, by the way, while you talk, I'm going to get set up because I forgot about that one.
Okay. So we'll talk a little bit macroeconomic environment here on the front end, and then we'll jump into Chaikin, and then we usually wrap things up, jump into Chaikin Power User, and then we usually wrap things up looking at your stock cheat sheets.
And I am Mike O'Connor. This is AA, retail investors and traders who've been doing this a while.
Yes.
The Fed this week is probably the market, since the West has planned economies, thanks to central banks, where we toggle between cascading downward spiral deflation / Great Depression, or hyperinflation, Weimar Germany, and fascism. So if the Fed is printing money, we're off to double-digit inflation and fascism, and if we're losing, if we're tightening, then we're in a cascading downward spiral of economic contraction, lower asset prices, more unemployment, and lower housing prices, right?
The boom bust cycle and the pendulum seem to be swinging further each time, each way past.
And each time the market was threatening to crash below what's been, I think, a fake support level, but was it 3,800-ish?
Yeah, that seems to be a pretty important line in the sand.
Yeah, between whatever the current administration is doing to prop up the market to stave off election losses, and whatever the Fed is doing to toggle between Great Recession and Great Depression, or I should say hyperinflation and Great Depression. We've been kind of stuck there. My sense is the rally has enough steam to continue. I still think it's a bear market rally that ultimately fails, and it might be pretty quickly after the election results are in.
Not only the election results, but of course, you alluded to it earlier, just a few moments ago. This week is all about the FOMC on Wednesday and their policy announcement, which really comes down to the 75 basis points this week, I think, is baked in. I think most everybody would agree with that. What we are waiting to see is what the guidance is for December and into 2023.
Yeah, for those of you who are, actually, I don't have my screen up yet, right?
No.
Yeah, so I'll put my screen up. For those of you who are watching, I will show you the most important thing that we could possibly focus on is not actually the Fed announcement. It is, thank you, CBS Market Watch, but it's Jerome's press conference. That's right, where the market move will take place.
Right. The result of this month's meeting is widely, I guess, known. We know what's going to happen. It's what's he going to say and what guidance is he going to provide. And I can't help but wonder if the rally the market has seen is kind of, it's been running off that quote unquote Fed leak a week or so ago, where they talked about slowing the pace of rate hikes. Now, I can't help but wonder if, much like CPI in September, the market is getting ahead of something that it presumes to be true, only to find out later that in fact it's not.
I think that's an incredibly high risk of reality.
And we'll find out soon enough, right?
We will. We'll get some little hints along the way. Remember, tomorrow, ISM Manufacturing Index, that's sort of a precursor. If the numbers come in soft and they're expecting, it to decline from 50.9 to 50, so not quite yet at a contraction level, but a slowing level. But if for some reason, especially before the holidays, those numbers got hotter, this is all about inventory for first half of next year, right? If you're putting a factory order in now, you're not building inventory for the holiday season. You're building inventory for the Memorial Day sale-a-thon. Well, no, the sale-a-thon's when you get rid of inventory. It's for the first half of next year. So if that number is soft, that's bad news. That's good news. It means the Fed will have some. I mean, again, this is a minor data point, but I think it's a directionally important data point.
Yeah.
And then we have, some other minor data points, construction spending, where we're expecting a slight improvement, but still in a decline. And vehicle sales, that'll be another minor one. The number last week was 13.7 million. And then we start ramping up. Wednesday, we've got the ADP, which will tell us about the job forecast. Remember, if we create more than 195,000 jobs, it'll probably be bad news.
Right. Although the non-farm payroll won't come out until post-Fed.
Right. So the Wednesday ADP is a telegraph that's often not this. They hardly ever agree.
Yeah. And also, I think, last week was the PCE number, which came in. It was pretty much in line with expectations. Definitely not a surprise to the downside by any means. And so you take those things in combination with the fact that the market just rallied as hard as it has off of some, disappointing earnings and big names. And if you're the Fed, do you sit there and wonder, is now the time to turn dovish?
Yeah, I don't think so. I think the rhetoric from the Fed officials, barring that one official a week ago Friday, the first and only Fed official to talk about, getting ready to have the conversation about slowing down the pace of rate hikes. Remember? That was the only dovish one.
Yeah.
Shortly after the Wall Street Journal leak, but really the Fed rhetoric in speeches that followed last week continued to be. Well, one even said she's changed her opinion about. I think it was a woman governor who changed her opinion about inflation. It's running hotter and longer than she would have expected, and thinks that we need to keep not only keep increasing past 5%, but to keep even when the pause is on, to keep it at a, what do they call it? Above baseline number. So basically a number that is, contracting the economy for longer.
Got it.
And that was a common theme reiterated by the Fed last week. So you're right. I think the leak might be a little bit, premature, but I will tell you, market participants are gearing up for I called this a FOMO rally. And, I don't think that rally is done yet. But Wednesday's rhetoric will tell a lot. If Wednesday's rhetoric follows through on the idea that if the data is there, I think there's enough on Wall Street that do believe that the pace of inflation is going to decline or reverse. They just have high conviction about that.
And I mean, it's a reasonable thought, because if you look at, the year-over-year inflation numbers month by month, beginning in November 2021, the numbers were much higher. So replacing those much higher numbers relative with even higher numbers is going to be difficult. So the data may start to soften a little bit on a year-over-year basis, which could provide that reprieve. I will say though that using the TNX as a proxy or a vehicle for judgment, the bond market doesn't seem to quite be buying into this notion of a more dovish Fed quite yet.
Nope. Bond prices aren't going up.
Yeah. To me, it seems to be a simple, throwback retest at a technical level on the TNX, at least, which is the 10-year.
So if the Fed keeps things vague on Wednesday and intimates that, yes, they would consider slowing the pace provided the data is along for the ride, then I think we do rally through Thursday, November 10th. And then if this number, which by the way, CPI is expected to, I don't know, we don't have forecasts yet. But last month there was an increase of the CPI before we go to core of 0.4, and it was even worse. It was 0.6. So a major change there would probably create the kind of rally into the holidays that I'm thinking might happen. The way the market is setting up for the Fed to keep things open-ended and for CPI to reverse.
Yeah, I agree. That CPI number obviously is going to be huge next week. And at that point, it's all that matters, because Fed will be passed, elections will be passed, earnings will be passed. That's it. That's the last thing that is going to, get in the way of a late year rally.
Now, Chaikin Analytics, which is a software program that AA and I use, neither one of us get compensated for it, but we do get access to it in exchange for using it on our now weekly videos. This can help somewhat predict things at a bottom-up level, because there's a power gauge that really does, I think, it belies the human being's ability to grasp and synthesize many metrics across dozens, if not hundreds of companies at the same time. And so a lot of times the power gauge on a company will change before even analysts start upgrading stocks. And again, we want to look at this stuff at a macro level to see if the market is getting more bullish and very bullish compared to kind of what the technicals were saying. And I mentioned this, that when I pull watch lists once a week just to look at what the stock rating looks like. And I did notice that, especially on IWM and on S&P value stocks, that there was a big increase in the number of very bullish rated stocks based on fundamentals in the past, compared to the past. And so that sort of gave me some anecdotal reason to believe that stocks would rally. Because sometimes you get a lot from the bottom up data. Mm-hmm. And so I was just going to pull up now for those of you who are not on video. We'll do our best to explain. The most important thing is we don't really have anything other than the US dollar in terms of major global macro ETFs that have delivered positive returns in the last 6 months. However, in the past month, we've had, quite a few things do better. And, interestingly, Eurozone, US small caps, US mega caps, the RSP, which is basically the non-market cap weighted version of the S&P 500. And if I had it on here, I don't have it on this one. The SPYV, the value portion of the SPY looks much better than SPYG, which is the high-flying tech, version, growth. Right. But transports are delivering a return, 4%. There's some industrials working, although I'm not seeing that here. So it's it's an improved picture, but with that, there's improved natural resource, in particular commodity, in the form of oil, fossil fuel strength. USO is back up on top with the 1 month look back. So things are, not necessarily out of the, and DBC, which is the broad bucket of commodities that features 40% energy, about 20% metals, base metals and precious metals, and the rest is all agricultural food commodities, basically chicken and wheat and soybeans and so forth. And then there's the euro. Of course, the ECB had a big rate hike last week. And so FXE and UUP are a little closer together. Actually, in the past month, the euro has outpaced the dollar.
The dollar's had a bit of a breather.
Yep. Now, the dry ships index has fallen apart. And my guess is that the Russian-Ukraine embargo didn't help. The agricultural shipments worldwide are slowing down. And China still looks terrible. But let's take a look first at TLT, because that, I think you mentioned, is the most important ETF out there.
I think so.
And it's still very bearish, one of the most bearish. And it looks like we basically had a bear flag break here at around 95 today.
And do you feel that a broader market rally is possible if yields begin to rise again?
Less likely.
Yeah.
Less likely.
I agree with that.
We needed that that 3 or 4 day rally in the treasuries. Certainly, certainly did. And then, of course, the shorter duration, which is really more what the Fed controls, that looks better. The longer duration looks not as well. The SHY, which is the 1 to 3 year treasury ETF, it too sort of had a bear flag break today, didn't it? Mm-hmm. So what we mean by that is we had a series of consecutive daily highs in the context of an overall downtrend. And we broke that, closing just under 81 today. Bad money flow. Oscillator's still rolling up, so it's only a day's worth of price action. But the short end of the curve and the long end of the curve, in terms of yield, both went up today, and the bond prices went lower.
And also that 3-month, 10-year inversion is still in place, which is a pretty important indicator.
Yep. So when we look at the major indexes, now I'm moving on to cheat sheets, as well. We kind of toggle back and forth between Chaikin and cheat sheets. I'm going to look at the fundamental ratios here in a minute. I'll draw your attention to relative strength. What we're looking at here is the major global indexes, and you can see, just like with Chaikin, the DIA is probably the strongest ETF in the globe. So that is benefiting from a falling dollar relative to euro and yen. It's benefiting from, I guess, the fact that there's more value stocks in the DIA, although there's a couple of tech high flyers there, but there's more dividend payers there.
Mm-hmm. Okay.
So that's doing well. It's in a intermediate uptrend, has a Chaikin money flow score of 0.1, which is bullish. And relative strength rotation has been persistently top 3 to 4 and number 1 recently for the past 160 days. Small caps look similar, doesn't it?
Yeah.
Top 5 ETF, persistently bullish, intermediate uptrend. All of these are in a longer-term downtrend, meaning the 10-week moving average, exponential moving average, is still below the 40. But like the DIA, the Russell is under accumulation. Chaikin money flow score of 0.16 makes it bullish, bordering on very bullish. And even the all-country world index, which is really not rotated the way maybe SPY has. SPY seems to be rotating into favor, kind of hanging in there in that number 4 or 5 spot among the 16 or so ETFs we're tracking here. No money flow on SPY. It's 0.04, so it's neutral.
Do you think the strong moves in DIA and the small caps and the Russell have to do with the fact that they're less tech heavy?
Yes.
Yeah.
Okay. Yeah. Because look at the Qs.
Yeah. Exactly. Yeah.
The Qs are really kind of in double-digit ranker land. Now I know they've in the last 10 days, kind of on the strength of an overall market rally. And actually software and services looks decent in tech, but overall tech looks horrible, particularly the heavy market cap weighted stuff, because Facebook was a disaster last week.
Complete disaster.
Did you read that Zuckerberg burned through 100% of the company cash flow on the to develop his pet project, which is Metaverse?
Yeah, I don't know what the percentage was. Was that what it was? I know it was significant and surprising.
Most of his most of the cash flow the Facebook threw off was reinvested into Metaverse.
Wow,
that's a big bet.
Yep, that's big.
And I have been an Oculus user, but the problem is I haven't really found anything new and innovative on that platform in 2 years, other than what I originally got it for, which I love. But they're going to need to do something to broaden the appeal of that out.
Yeah,
and maybe lower the cost of the headset. Who has $500 lying around?
Yeah.
And those headsets break, by the way.
Interesting.
Yeah. Now, DBE is, again, persistently strong. It had kind of a weak retracement week, but again, we're talking about it's probably the only global ETF that's in a multiple time frame uptrend with a 0.17. So I kind of look at this this last 10 days as sort of a consolidation, but it's pretty solid, I would say.
Yeah.
So the inflation narrative, particularly food and energy, is still very much alive and well. And we can segue over to our global relative strength in commodities and get kind of a more of a drill down here. Now, we include some of the U.S. market in there. And we do notice that, again, it's not everything and it's only recent, but lately equities, last couple of 20 days or so, are enjoying some superior relative strength ranks. But it's basically an oscillation back and forth between commodities and stocks right now, headline driven.
Mm-hmm.
So I wouldn't call the move farm equipment rotation real. I wouldn't yet call the SPY rotation real. I wouldn't call the ACWI real, not until we get into the sweet spot zone of between 60 trading days and 120 days or 3 to 6 calendar months. We're looking for relative strength rotation in this zone that then sticks over here. Like here's probably a good example of SLX. That's legitimate relative strength rotation. Good money flow, confirmed uptrend in the intermediate time frame, and a move from 17th to 2nd. And despite some pullbacks, we maintain a 3rd and 5th rank the last 10 to 20 days. So that's kind of what we're looking for. That is, and gas would be another one, wouldn't it?
It would. Yeah, the consistent performance.
Yep, moving 26, 23, 15, 6, hanging at 1, little pullback to number 6 here. That's a minor pullback. Multiple, time periods of uptrend and a bullish money flow.
Yep.
And then below that is the Brent oil, which again transitioned in a similar way to USL, and the accumulation score is even higher. Lithium's right now kind of in a bear consolidation. We don't know if it's returning, but the money flow score tells us this may be where the puck is headed next. And then what's rotating bearishly?
I don't know what's rotating bearishly. There's obviously a lot that's been bearish.
Yeah, I don't see anything really. There's stuff that's starting to fall, but there's stuff that's either been persistently bearish.
Yeah, like bonds.
Like base metals, bearish. Bonds, right, which we put in here for comparison purposes, right? Because obviously the higher interest rates go, the worst treasuries do. And this is, of course, the long end of the curve, TLT. But when you have that, usually commodities don't do as well. And then natural gas, we kind of explained, is more of a probably a short-term supply and demand effort. Notice that it's the demand is destroyed, but the accumulation, people are buying the dip.
Right.
In other words.
Right.
Yep.
It's been pretty volatile in there in natural gas. I've been trading.
It has been. Yeah. Yep. So then we can go over and look more at the technicals here. So this is all kind of the relative strength rotation. But then we're able to go to our trading signals cheat sheet, which, by the way, you can get a free subscription to this at stockcheatsheets.substack.com. I put this out a few times a week. And for the stuff that's complete here, we've got global indexes, which we can look at here. So tailwind score is sort of a composite of various technical indexes. Anything over 50 is considered to be pretty bullish. And so you have, again, U.S. mega caps and small caps, along with Latin America. We've explained that's mostly natural resource and energy. It's about 3 stocks. It's mostly Petrobras and a energy company or a basic materials company called Vale. And that's it. So it's 2 tickers that's driving that.
DBE in there.
Yeah, and there's DBE. And so the most interesting, when you look at this in terms of technicals, the ones that are telling us there's the possibility for a sustained rally is when you look at factors 7 and 8 in our pre-trade checklist. These are not actual trends. These are the forecast of potential trends. And whenever you have the months to maybe a year or two forecast and the weeks to months forecast, meaning the long-term and the intermediate term forecast, both agreeing, meaning our version of weekly bullish is neutral plus. Our version of, bullish on an intermediate time frame is, or this is very bullish. So this is at an extreme position. And whenever you see these 2 time frames in agreement and one of the junior time frames pegging the needle above, in this case, 80, it means that follow through is likely. Now, we don't see this in many places. I'm going to discount Latin America, but so U.S. mega caps are it. We also have Eurozone, interestingly enough. Isn't that crazy?
That is bizarre.
Yeah. And so we have a bullish intermediate trend in the Eurozone. We have a slightly bullish long-term forecast, a very bullish intermediate forecast. We did get a pullback here, but it just shied away from going into the super red. We call this a heads up. When it gets below 5, it becomes a danger zone reading, and it kind of negates the buy the dip signal. But that is a legitimate buy the dip signal when you have a very bullish intermediate forecast and you have no line below. We're supposed to get this line needs to be above 80, but I think what happened was this is Eurozone. That buy the dip signal looks a little off to me. I need to go check that on the charts. EZU.
Yeah, I'm looking at it right now, and I think that it's actually accurate. Barely.
Yeah, it's a barely accurate, right? It's probably right at the cusp.
Yeah.
Where after hours it turned a different color. That's what I'm thinking.
Yeah, I think
I
that is valid though.
Let me just check that. Easy use. So the market forecast, I'll show you what this corresponds with. So when we look at this, the senior time frames, this one, which is rolling up but below 50. So this would be what we consider to be neutral plus, rolling up above 20 but below 50. Okay. This one has crossed above 80 and would be considered very bullish. This is below 10 but above 5. And this one buy the dip because it's below 50 but above 20. That is a buy the dip signal. We also had a moving average cross, so we expect a light volume pullback followed by a bounce. That would be the next expected move here. A trade above the high of the low day is what we could expect next. So traders that catch buy the dip are expecting a bounce. You're doing it earlier, and so you get a slightly better return, but in exchange for not being right quite as often, right? Because sometimes these pullbacks can keep going.
Yeah.
But Eurozone that is a classic buy the dip signal, and these always work out better when you have the long-term direction of the market going in your favor. Like compare that to the SPY, where we don't yet, though we're dangerously close to getting a reversal here. So we did have we've got a head and shoulders reversal setup that actually broke, didn't it? It's a very minor, small head and shoulders reversal, but there it is: shoulder, head, shoulder, breakout, throwback, retest to the neckline, bounce, confirmed by intermediate time frame, intermediate trend, which crossed above 20. That's intermediate stage progression 1, above 50, intermediate stage progression 2, above 80, intermediate stage progression 3, completed. Very bullish on SPY, confirmed by the blue line barely above. That's the near-term line, barely above 80. But this is portending better things to come. And this moving average cross looks like it just happened today. So that's a series of buy signals. Now compare that to Qs, where we don't have anything like that, right? But we do have, so we have a bearish. The difference between this and the other signal is the line is in the same place, right? It's above 20, but it's pointing lower. It's below 50, above 20, but pointing lower. That's straight out bearish. If it falls below 20, it gets very bearish. So it's telling us that there is a long-term drag on the Qs.
Yeah.
And it will take a more bullish version of this. Notice that the SPY's intermediate trend had already progressed to a stage 3, above 80. This one hasn't yet to cross. Oh, actually, it has crossed 50, just barely. It's in stage 2. But notice that we didn't get a trend progression signal, AA. We didn't get this near-term line to move above 80.
Above 80, right.
So an unconfirmed trend progression. It just shows the relative weakness of NASDAQ. Moving averages aren't ready to cross. So that is the drag on the market. DIA are most bullish.
Would I be wrong if I noticed and pointed out that volume on all of these seems a little bit lackluster?
It's very lackluster. Yep.
Okay.
Yep. So Dow is almost recovered to its summer high. Not quite. About a 2/3 retracement, I'd say, eyeballing this.
Yeah, seems right.
Double bottom. There's your breakout, not on great volume. Throwback retest, bounce, run. Intermediate stage progression from below 20 to above 80. Confirmed on a couple of occasions. Each progression confirmed by near-term line above 80. And at least the stage 2 is confirmed also by a momentum line above 90. So all very bullish. And then the question is there other stuff setting up to do that? Because we need a more broad-based rally. But EEM is not set up like that. The emerging markets looks like it's traipsing along the bottom, doesn't it? Now, China is probably helping keep that one low.
As is the US dollar. And
the US dollar, right. Although the US dollar is getting a little cheaper. And there's China just crashing. Look at that. It is. Yeah. This is like, it looks like an economy going terminal, doesn't it?
They've got problems.
That's really bad.
Yeah.
This is a colossal break of long-term monthly support that I can't even tell you how far back that goes.
Do you think that's foreign money fleeing the possibility of them messing with Taiwan?
Yep, I think so. Or foreign money also just worried about the continued COVID lockdown policies.
Yeah. Or both. But
there's the long-term break. This would be, I'd say, a support area here. The last time it did this was the famous financial crash. We're now lower than the financial crisis.
Mm-hmm. And while I don't know the numbers off the top of my head, they've been repegging the yuan. They've been monkeying with the value of their currency.
Yep. As has Japan, as has the Bank of England. So
that's right.
That's our money printing part of the deal, where the central banks are trapped. The consumer, I just wanted to let's take a look, see what kind of shape the consumer is in from a technical standpoint. Then I'm going to head back to Chaikin.
Okay.
So I guess the glass half full way to look at this is that we've got a potential humongo double bottom on XLY. That's really glass half full, probably on a weekly to monthly basis. But right now we've got, we're only in stage one intermediate trend, and it's starting to flatten, and the intermediate long-term sentiment, the long-term sentiment on XLY is bearish. We are mildly bullish or neutral plus on the intermediate time frame. We did have some oscillators pushing higher, but it looks like XLY is lagging the market. We need the consumer along for the ride for this to be a broad-based rally, right?
Right.
I will point out that I don't know how today's price action, but XRT looks much better. XRT has a bullish moving average cross. Notice that we're in stage 3 in terms of the intermediate time frame, but still bearish on the long-term sentiment. So still pointing lower, below 50, above 20.
As an aside, did you see today, it was reported today that credit card debt has hit its highest point ever?
Yeah. The consumer looks stretched to me.
Yeah.
And paying higher prices. We just looked at the commodity prices. They don't look great.
Yeah, they don't.
And here's metals and mining, basic materials, stage 3, at the risk of the sentiment turning around and crossing above 50. These look like they might be off to the races. So what we may be seeing, AA, is an inflationary rally. Value stocks working, but in commodities. I mean, if we look at DBC.
And how would you expect that to express itself in things like XLP with yield? Do you think, would it be benefiting XLP?
Well, XLP looks darn good. Look at that.
Okay. So the answer would be yes.
Stage 3.
Yeah.
Still, we don't yet have the sentiment turned around yet. So, but a lot of stuff has exploded higher. But again, that's defensive, but it's working, and it's yield, right? Value play.
Yeah.
More value in healthcare. Look at that. Value. Look at SPYV. This is the S&P value. So the value stocks. Look at that trajectory. Stage 3. Look at that. The oscillator has curled. It's at a low point, right below 50, above 20, but curled higher. Higher here, confirmed by the near-term line. So the market forecast lines are headed in the right direction. Meanwhile, SPYG doesn't look nearly as good, does it? Although it is bullish. Bearish, bullish, so contradiction, more of a sideways pattern, but just not as strong. So yeah, XLP, XLV, and even, believe it or not, XLRE. Mildly bullish. Only mildly bullish, not cross 50 yet.
Right. Also, XLF looks.
Yes, XLF, right?
Yeah.
Which would be a higher interest rate play. And there it is. Stage 3 uptrend there. And most importantly, the market sentiment line has turned and moved higher. So 2 time frames in agreement, confirmed by the blue line above 80. Move higher, moving average cross. Yep. So it is the value stuff, the non-cyclical. That's what's working right now. And the cyclical not working as much, although energy and certain commodities are an exception. All right, into Chaikin we go. We'll take a look at the bull-bear ratio on the SPY.
Which, as of yesterday, was surprisingly positive.
Look at that. So this is another, I'd add this to the bullish thesis double.
Yeah.
Yeah. We also have, now, when the market is trying to recover, when we have these kind of oscillators making, at first this was a series of divergences. I don't get as concerned about us pegging the upper reversal zone on this first pass. Now, we need to get eventually a higher low. But we're still in a downtrend, right?
And that 200-day Chaikin moving average has been a formidable opponent for price.
Yep. We also don't have positive money flow, though it's improving. And of course, this relative strength is comparing against the SPY. And then the power gauge is neutral, but that's probably because the technicals are bearish, but the fundamentals appear to be bullish. 146 to 99 now.
Yeah.
So that is a significant change from when we did this last week. Significant, right? It was, I think, half that.
Yeah, last week it was 0.55 was the ratio, and then
now it's 1.5-ish.
Now it's 1.5. Exactly right.
So it's 2-to-1 on DIA, IWM, and again, this is just a measure of the fundamentals, bullish to bearish, bullish and very bullish. And this one's turned around now, 569 to 422, up above declining long-term moving average.
That's right.
So in terms of market conditions on the SPY, I'll just go back to that. So neutral power gauge, we have that's a non-bullish rating. A bull-bear ratio, though, is positive. Price is below a declining long-term moving average. Those are two negatives. So one positive, two negatives. But above a rising short-term moving average, that's two positives. So this is a market neutral positive potential.
Yep.
A shift from, I think, market neutral negative potential a week ago.
That's right. Yeah. It's the ratio now that bull to bear ratio has changed the game a little bit.
So let's go and look at the sectors first, and then the subsectors to see what the bullish and very bullish fundamental rating looks like. I'll be curious. Oops.
Not to be a spoiler, but it's expanded on the bullish side, as you might imagine.
Why am I not allowed to organize this the way I used to be able to?
I think. Are you trying to just see the 11?
Oh, I need to do it down here, don't I?
Yeah, that's right.
Okay, that's what it is. There we go. So here's the SPY. Believe it or not, tech is working, but you're going to find the tech is very specific to innovative tech and software and services. Right. But there's the consumer underwater, communications underwater. There's Google and Facebook is in there. Mm-hmm. Utilities underwater, basic materials underwater, but the technicals aren't. And real estate underwater. What's working is energy, financials, industrials. That is not a top three. Those top three aren't bear market top three at all. And then healthcare, tech, and staples. That's a lot of ETFs outperforming the SPY. That is not a market that's getting ready to crash double.
No, it looks pretty encouraging this week. I think I'm very anxious to see how the week treats tech in particular.
Yep. From a subsector perspective, there's financials. So insurance, I think capital markets is working. Banks are working. There's a number of industry groups all working. This is regional banks, money center banks, insurance companies, all with hugely positive bull-bear ratios. Capital markets, I mean, it's almost a clean sweep, isn't it?
Yeah.
KCE. And there's XOP, so that's energy, more energy. This is oil services. The OAH would be the equivalent here. And then in healthcare, we have biotech. There's home builders, 11-2, believe it or not.
That's insane to me because I just finished reading a piece about cancellation rates and the headwinds home builders are facing. So
now there's no technicals here, so it's fundamentals only.
Those fundamentals are a little surprising to me.
Yep, and the power gauge hasn't moved to bullish.
Okay.
Yeah. So remember that this sometimes you need to kind of look at the ETFs and their ratings too. There's two different feeds. Yeah. Remember, and the Chaikin model is based on their proprietary feed, so it's going to be this one. And so this is the way to do it. We'll stack rank these and bullish to bearish. So they're calling energy, industrials, healthcare, and mega caps very bullish.
And small cap. Oh, and small caps are bullish. Sorry, I jumped ahead.
Small caps bullish, ACWI bullish, financials bullish, staples bullish. And then basic materials, communications, and tech are neutral. So this looks like a market kind of in transition a little bit. Mm-hmm, mm-hmm. You know. But when you kind of go through the checklist, DIA, bullish fundamentals, up and above two now rising moving averages. A relative strength versus the SPY looks great. Money flow, not persistent by any means, but strong. Somewhat strong. and power gauge immediately shifted or just shifted from yellow to green, you could argue that we are in the middle of a personality change.
Yeah.
Energy, of course, has been, this is more of a classic bull. Big consolidation over the summer. Here's your drawdown of the strategic petroleum reserves. That demand is waning. XLI, and you're going to find that XAR underneath is what really is driving this. So watch this. So XLI is very bullish. Now I'll go down to subsectors.
And XAR is
aerospace and defense.
Yeah.
So, and I don't know if the fundamentals have caught up, but I can tell you the technicals have. There's XAR, bullish. And again, hasn't finished the diagonal downtrend yet.
I was just going to point that out, and it's been kind of a theme, is that price is approaching those diagonal trend lines.
Yep. So they're going to fight those, but double bottom breakout here. Off to the races we go. At some point, we're going to get a retracement. But but this is a classic Chaikin personality change ETF, isn't it?
Yeah.
Up and above 2 moving averages where it had been below them. The transition of money flow, the transition of relative strength, and the movement of power gauge from green to yellow to red in the last month and a half.
And also, I could be incorrect. I don't see it so well on my side, but the long-term moving average looks to be attempting to point north.
To curl higher. Yeah. So we often say that this oscillator here is sort of in between the 2 market forecast oscillators, the long-term and the intermediate-term oscillator. And this one is sort of kind of right in the middle of those 2.
Mm-hmm.
So overall, I'd say certainly not overwhelmingly bullish, but we could be a couple of headlines away from either major reversal or major continuation and a more broad-based rally.
Right. And the wind could go either way.
Yeah, the wind could go either way, and I think so the way I look at it is the Wall Street firms are tracking inflation with their own proprietary research, or they're talking to government officials for leaking shit to them for in exchange for kickbacks, whatever it is,
whatever it might be,
whatever the non-public information is. I think Wall Street is gearing up for a rally that could very easily be derailed by one sentence from Jerome Powell.
That's right, and we all know that Jerome Powell is time and time again proven that he's not a very good communicator in these situations.
Yep. Although I think he's also decided he does not like what the wealth effect does to this country, because then the country throws money at at stuff and raises the price.
Yeah.
So he's incentivized to kill this rally.
I agree with that. I just want to circle back real quick to something I said a moment ago about inflation and the month-over-month numbers. So in 2021, since we're talking about November CPI coming out on the 10th, the number from the previous October, which is what we'll be looking at on the 10th, is 0.6.
Right.
So we have to, if we replace it with a much smaller number or a smaller number, it would look encouraging, right?
Yeah, you're talking about the core CPI, right?
That's right. That's what I'm talking about. Just to go back to that number.
There it is. But I think this would have to be, if this goes up again,
yeah,
it's going to be a disaster for the market.
100% agree with that. If it's higher than expected, higher than that 0.6, which is what we had last year too, which means that inflation would actually be rising year over year.
Yep.
That is going to be a disaster.
Listen, even if it's higher than whatever this consensus ends up being, it's going to be a problem.
Yep. I agree with that.
Yeah, and the other thing is this 12-month change is very uncomfortable at 8.2%. I think a 7 handle makes the market feel a little better.
Yeah, I agree.
And a 5 handle on core.
Yeah,
meaning on the 12-month change.
Right. I don't know. I mean, who knows how likely it is? It doesn't seem very likely, but I suppose it could happen.
Well, the thing is, when, markets step up, but they crash lower. So when it happens, I think it'll be dramatic.
That's right. Up the stairs, out the window.
Yeah. So a dramatic out the window for inflation means a huge up the stairs for stocks. And vice versa.
Right.
And I think we've kind of said it. I think we could show you more data. But I think that what we've done is shown you kind of what's going to happen. 2 scenarios.
And now we wait and see.
Yeah, and I would say just based on how Jerome has thrown a cold face cloth on the market, value stocks and dividend payers are probably as far as I'll go in terms of the flyers I take until we get more data.
Yeah. And I'll probably just sit mostly out.
Yep.
For the time being, personally.
Yep. Yeah. Well, my delta is almost flat now because I just can't. I feel like I don't have an edge.
I think that's probably wise. Mine's a little short, probably a little shorter than I'd like it to be, and I'm going to try and rectify that tomorrow.
Yeah, mine's minus 75, but down from minus 500 a week ago.
Oh, man, that's quite the change in delta.
Listen, I moved it up. You know, when a call spread goes underwater, I get out of it just like you're supposed to at 1 times the credit.
Got it. Yeah.
So I've learned to shut those call spreads off when they don't work.
Well, my delta is about as short as yours at the moment, about negative 80.
Yep. There you go. So we'll see.
I'm going to flatten that out and add a little theta maybe.
Yep. So when we get together this weekend, we'll be able to, we'll have part of our answer. And then a week from this weekend, when the CPI for October, the first print of CPI for October comes out, we'll have our answer.
It seems that after that CPI print hits that we're going to pretty much have a decent idea how the rest of the year is going to go. Would you agree with that?
I would. And I'd also add that there will be closure probably by that weekend on how the House and Senate are going to look.
Yeah.
And the markets tend to like, paralysis. Yeah. So I think a Republican win, not that I'm a Republican, but I'm just laying it out in terms of the scenario. A Republican win of the House and Senate, I think would encourage the market because neither faction can exert a policy that will create instability, if that makes sense.
Because at that point, the next 2 years are basically wasted with in regards to regulation or anything.
Yeah, we're just basically we're basically trading on pre-presidential election rhetoric.
Yep. All right.
When there's nothing left to say, we close it down. Thank you, the two of you who decided to listen. I am Mike O'Connor. This is Double A. Go to stockcheatsheets.substack.com to subscribe to our free letter. You can go to chaikinanalytics.com to sign up for a trial subscription for Chaikin. We are not affiliates, so we don't sell subscriptions to Chaikin, but we do encourage large account holders. It's a great platform. And finally, to get the podcast, Macro Monkeys, go wherever you get your podcasts.
And if you're listening to the podcast, review it once complete. We would appreciate that.
Yeah, and click like and thumbs up and subscribe. It teaches the algorithm to distribute us to more places so we can spread the word.
Yes, we appreciate all of that.
Thank you.
Thanks, Mike.
Talk to you later, Double.
See you.